What's up, YouTube? It's Joe Catrapalia sitting on the couch making some money investing in fractional real estate online as usual. Today I am just sharing my January portfolio results for Mogul.club. If you haven't been following along, Mogul is just a platform where you can invest in fractional real estate. You buy basically just small pieces of investment properties, get paid rents monthly as long as everything goes well. Someday in the future, the property gets sold. You make some money on appreciation. I don't know why. I know if you've been watching my channel, you know all about this, but I find some of the certain videos attract new viewers, and the portfolio updates seem to be one of them. So I just want to throw that out there. So I currently own 18 properties, little pieces of 18 properties on this platform. I started with bigger chunks before I realized how often they put properties out. And then, dropped down to doing little tiny pieces until I thought a little bit about the fact that I get a K1 for every single one of these that I do. So I'm going to have to hand over 18 K1s to my accountant. He's going to charge me for the time that it's spent. So at some point I just decided, okay, I'm going to do sort of medium-sized chunk in each one and just not buy every single one that they put out. Let's see. So a little bit, my dividends have continued to be a little bit disappointing. It's driven down almost entirely by my short-term rental. So if you look at my annual yield this year so far, and it looks like in January they restarted the annual yield. So only 4.27%, which is pretty sad compared to if I just looked at the pad splits I bought on here. And really actually sad compared to some of the, my investments on other platforms, right? So this is, I'm going to be really selective with any future short-term rentals. They provided a lot of notes about, different things that they're doing to try to make the short-term rentals work better. And also too, that, this is not the best month necessarily. January is typically not a strong month for short-term rentals, in the locations that I own them. And so, I think there's the potential to outperform, in the summer months, and then maybe that makes our annualized number look a little better. I do think this was my, end of year annualized yield last year, right? 6%. Again, not great relative to what they're advertising, almost entirely driven by the fact that my short-term rentals are doing terrible. And it's what I was buying more of earlier on. So I bought the very first property I bought in here was the Axelrod. This is a duplex run as a short-term rental in Houston, Texas. I was really excited about this one. I actually think that they bought it at a great price for what it is. It just hasn't performed well. And I think we have another note this month. Okay, so they did a design refresh in January, changing two of the rooms, adding some to where it can sleep more people. They're hoping this generates, more money, but it interrupts January. So, we had a pretty lousy January to where it was a negative cash flow. We do have pretty large reserves with these properties, but after several months of this, I'm starting to get worried about where we're going to be. And you can see it started off doing okay, and not amazing, but okay. And then over time, just, we've had a lot of zeros in a row as far as cash flow goes. The roads, this is the first pad split I bought on the platform. This is a pad split in Mesa, Arizona. And it's done fantastic, since the very first month that I purchased it. I would say this is why I was excited to buy more pad splits in Mesa, because of how well this one has worked. We'll see. They do still give us, we did have a move out at the end of January, so maybe next month isn't going to be as great. But overall, I'm very happy with how that one's doing. The WAGs, this one is kind of interesting. I don't fully understand. There is a title insurance claim going on. They said in the webinar, I think that they expect that to be wrapped up in about 30 days. So I haven't fully grasped how we're also trying to operate the property at the same time as I don't fully understand the situation. I thought that we had lost the property altogether, but now it looks like maybe we are having the opportunity to run it. So I'm not sure, but I expect that they mentioned the title insurance claim on the webinar, and then also mentioned getting some sort of restitution from the people who caused the problem, who took the loan out, and going back to that seller as well. So I'm hopeful that we'll make some money on this, but it is, it's still one that's been up in the air for a while. And it's another short-term rental that I was kind of excited about and has just been very disappointing. The Mafi, this is another, where is this? In Decatur, Georgia. It's a pad split in Decatur, Georgia, and it's another one that's just performed extremely well. I mean, you can see why I've been much more up on the pad splits than on the short-term rental so far. The Johnson, this is, what is this, in Austin? Yeah, Austin, Texas, short-term rental. Another one with a negative cash flow. We're not even covering our debt service right now. It's a good thing we just have a big reserve. I would really like it if they included, and I don't think they do anywhere, what our current remaining reserve is. It would be good to know that, because at some point, we're going to have to start worrying about what we're doing if we just keep having these negative cash flows. Strong operational foundation, huh? Well, okay. It's just not enough. Net rental exceeded our monthly debt service requirements. That doesn't seem true. Debt service, levered cash flow. No, that I think that note might be off. The property, yeah, I'm not sure what's going on here. Either the numbers are wrong or that note doesn't make sense. So if anybody's asked the question about this already, let me know what they found out about it. If not, I guess I need to send that in and say, hey, what's actually going on here? And you can see, we need a significant amount more top line revenue. We need to be around, even better than the October, November numbers for this to make a lot of sense. I had pretty high hopes for a lot of their short-term rentals. I mean, they look like fantastic properties. The Celeste is another one. This is another short-term rental in Houston, Texas. This is how we're doing here. Oh, negative cash flow again. What are they saying? Yeah, poor, only 39% occupancy. It says it's covering the debt obligations, but we have a negative cash flow. So I don't understand. Oh, they're saying the revenue. Okay, I get what they're saying. They're saying the revenue is high enough to cover the debt, but with everything else, we're still losing money. So, I mean, that's a weird way to frame that. March forward booking show 45% increase in ADRs. Okay, so that's good. But again, I think it should be a slow month, but we've just had a lot of bad months for their short-term rentals. The Victor, this is another pad split. Where is this? In Atlanta, Georgia. And is this one? This is another one that's just had fantastic returns. So you can see sort of a theme here, right? Like my pad splits are all crushing it, but I spent more money on the short-term rentals early on because that's, I don't know. In a perfect world, I would have made the same investment, the same amount of investment in every single one. It just took me a while to figure out what the right number was going to be. And over time, I'm sure that'll, at a certain point, I'll probably start doing bigger chunks once I'm more comfortable with this particular platform. If you remember, all of these platforms, right, I'm just experimenting on, which reminds me, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online. But you want to do your own due diligence on all those platforms. Just because I provide the links doesn't mean I'm saying that you should invest on any of them or in any particular properties. You want to do your own due diligence. Make sure that they make sense for you, your specific situation. Also in the description of this video, I have a link to a Discord channel I set up where a whole bunch of us talk about several different fractional real estate and investing platforms on a regular basis. We share a lot of due diligence tips on different properties, like, which is very helpful for me and is kind of the point, right? I'm hoping that we're all going to share ideas, strategies, share new platforms, all that sort of thing. Okay, the Andres, this is another pad split in Decatur, Georgia. Another annual yield, 10% across the board, right? I mean, it's just done really well. The Chelsea, this is Atlanta, Georgia pad split, and fantastic yields, right? Like if I had only invested in the pad splits, I'd be doing amazing right now. The Ratliff, Douglasville, Georgia pad split. This one's a little bit lower, but it's still, I mean, high single digits, mid to high single digits at 8.7. I'm pretty happy with that, for a cash on cash return. The Ven, this is also Lilburn, Georgia. I think this is one that's doing not so well. Yeah, I mean, okay, now we're seeing a little bit lower, mid single digits, and it was fully occupied in January. I don't understand. I expect that we would do a little bit better than this. Fully occupied, but you can see like, okay, maybe December picked up a little bit more of the rents because they pay weekly rents. And so with rent schedules, it's not always perfect how it goes from one month to the next. The Hugo, this is a Dallas, Texas short-term rental, and not to disappoint, it is giving us a negative cash flow just like all the other short-term rentals. Occupancy over 70%, which is actually kind of scary that it was over 70%, and you saw a rebound in January, climbed to over 70%. Yeah, ADRs, March is currently outpacing ADRs 34% higher than January. Why aren't they telling us February? Forward looking. That's kind of interesting. So at least and ADRs have to go up in order for us to, because 70% is not terrible for occupancy for a short-term rental. Like you can't expect them to be 100% all the time. 70% is basically you just missed one of the weekends, right? Or one of the weeks basically. The Pinkman, this is one of my first disappointing pad splits. It's another one. It's in Atlanta, Georgia. Interestingly, this is one that I was kind of excited about because it was one where we had the seller do some work for us and before we purchased it, and so it was an interesting value add strategy, and it hasn't gone very well. And the only note is that we had one move out in January. What seems to be killing us on this one is just higher OPEX relative to our top line revenue. I mean, if you look at this revenue, it's kind of in line with our average. And I don't know. I mean, are we just going to expect that higher OPEX number all the time? It seems like it's more so, about $700 higher than those other properties that are similar. So I'm not sure what's going on there. The Gilmore, this is a Tempe, Arizona pad split. And it didn't start off the year great, but the prior months it's done pretty well. A lot of times, this 21% was because there was no debt service that month, right? They weren't paying taxes, insurance, or debt service because it was the first month after the purchase. But 11, 10. Okay, now we're still in high single digits though, so I'm pretty happy about that. The Swift, this is again short-term rental, and again negative levered cash flow. Hopefully they figure this out, right? I mean, to have just my whole portfolio. I don't know what their other how their other short-term rentals are doing, but every single one that I've picked has a zero or basically zero yield negative cash flow, which is not good. And they've mentioned transitional January with limited occupancy, because I think they switched over who's doing their their revenue management for them. So hopefully we see a turnaround with the short-term rentals. If not, I mean, it's a big chunk of my portfolio that is performing poorly. And then the other thing that's dragging down my average is I have now 3 properties that I've purchased that haven't paid out yet, and so that does impact the math of the the portfolio. At least the ones that I already owned. I don't think it actually will impact. This is showing 2,500. So the last 2 purchases don't show, but the one before that, right? So this is showing 2,500 investment, really only getting yield on the 22.5. These returns, one, having a blended yield of 4.27% isn't terrible. It's definitely disappointing when, compared to their marketing and compared to their projections. If the short-term rentals, I probably won't buy another short-term rental from them until it becomes clear that they're able to operate them the way they think they can. But the pad splits have all, on average been I've been very excited about the way they've gone. A lot of them are pumping out returns higher than I expected already. So I'll continue to buy those. I'll continue to buy the long-term rentals until I find some reason not to. It is just, it's a shame that my my largest investment and some of my other earlier investments were, these short-term rentals that are just not performing the way that they're expected. I'm curious, how's your portfolio doing if you're investing on Mogul? Have you had similar results? If anybody has a short-term rental with them that's doing well, I'd love to hear about that. It's just shocking to me how consistently poorly my short-term rentals are doing on here. And it is, it's not the best time of year, but that's not the whole story, right? I mean, there's definitely, I work with a lot of short-term rental operators, and they're not all doing this poorly right now. And all of them are in Texas, right? So, I say that. Most of them are in Texas. Anyway, that is my January portfolio results for Mogul. And that's it. So until next time, I'm just going to keep making mistakes so that you don't have to.